LukeGromen, the founder and president of FFTT LLC, is joining us. Luke, welcome. Good to have you with us. The TNX to a new high I saw yesterday, tied to the Biden administration BBB, this bill that we're hearing about. I guess we're going to get more details today, but is that what's behind the move in terms of, it seems like it's playing out more in the belly of the curve right now, not so much the longer end?
Yeah, I think that's right, Ben. Thanks for having me on. I think it's a combination both of the recovery we're seeing, but I think also, more importantly, in my view, is that I think the bond market is starting to realize that it might be the proverbial sucker at the card table, which is to say, we've got a recovery happening. Biden comes in, does $1.9 trillion. The ink isn't even dry on that $1.9 trillion, and now we've got another $2.25 trillion with, in theory, another $1.75 trillion or $2 trillion on the come a couple months from now in some other things. And so ultimately, I think the bond market is starting to sort of say, wait a second here, this 5 to 10% GDP growth, this might not be one quarter. It might be 4 quarters or 6 quarters or 8 quarters or 10 quarters. And if you're holding a 10-year or the belly of the curve bond somewhere between, whatever, 1.5 and 1.7, while GDP is running 5 to 10 for the next 2 years, that's you're losing money on a real basis. And so I think that the bond market is starting to discount that, but I don't think it's fully there yet. But I think it's starting to wake up to that dynamic of the disparity between what could be a sustained period of very strong U.S. GDP growth relative to where rates are right now. That
being said, Luke, should we be keeping an eye on the shorter end of the curve right now? Because it had been the longer end, which was leading. We'd watched the curve steepen some, but with the 10-year now trying to play catch up, the 5-year also participating. I saw a new low for the month of March there. I mean, should we be watching the 2s, the 5s now to get an indication of a real good gauge of where the market's at?
Yeah, that's a good question. I don't have a great feel for that. I mean, with the short end, we've got the TGA being spent down, which all else equal is putting severe pressure downward on yields. And you've seen the Fed take some steps with some of the reverse repo programs, et cetera, to normalize the front end. The longer end is, doing what it's doing. I think that's probably not a bad idea in terms of getting a real sense for where the market's at. Obviously, in February and into March, we had some sloppy auctions from the 7-year tenor out. Mm-hmm. So maybe the 2 and 5 are a little bit better read. Don't have a great feel for that, though.
Okay, I want to pull up a chart here real quick because I did want to point out, as I mentioned, we just looked at the 5-year a second ago. Here's the 10-year real quick. I just kind of want to work my way through the futures contracts. You can see the new low yesterday down below the 131 handle, but notice how, and this is what I'm pointing out, the bonds didn't participate. Keep in mind the longer end had been leading to the downside relative to the short end. Now, I do want to point out the 2-year not participating. You can see that here, but again, getting back to that 5-year did participate. Luke, where does this leave the U.S. dollar? Because one thing we've been watching recently is it does appear to be firming up some over the last few weeks with rates to the upside, not necessarily the relationship we've seen in the most recent past years, but we could be looking at a different dynamic here.
Yeah, I think that's right. And it's a really interesting dynamic because all else equal, if you have, I think ultimately the answer is it comes down to what does the Fed do? If the Fed buys enough or keeps buying enough in terms of treasuries, then I think it's likely to be bad for the dollar. With that said, if the Fed does not buy enough of the U.S. deficit, of the Treasury supply, then I think it's possibly really good for the dollar, which is because they'll be running what we've referred to as the Soros and Druckenmiller strong dollar playbooks. If you go back to the late 80s, Druckenmiller is on record saying, George Soros had this radical currency theory that said that if you run really big deficits, so really loose fiscal policy, but tight monetary policy, the currency will actually rise. And the U.S. actually did it in the early 80s, and Druckenmiller said that was his test case. And where he applied it was to the Deutschmark when Germany reunified back in the late 80s. And he said, I could see it clear as day. They were going to spend a bunch of money to reunify the country while the Bundesbank wasn't going to accept any sort of inflation from it. And so they were going to run tight policy. And so I expected the Deutschmark to rally strongly, and it did. It was a great trade. And so looking at what Biden is doing, the Biden administration is doing, it's looking like we have this massive stimulus coming, these strong GDP growth coming from it. So it really falls on the Fed, which is, for the time being, as yields are backing up, the Fed's not doing enough. And that, I think, is good for the dollar. Now, at some point, yields, in theory, will hit a level where the Fed is forced to cap those yields. And at that point, I think we would see a weaker dollar. The other issue is that at some point on the dollar, the stronger dollar begins to hurt global growth, which quickly reverberates back into the U.S. economy and becomes counterproductive. So there's a couple different breaks on the system that I don't know exactly where we'll hit them, but I don't know that they're that far from today. But for the time being, what we're seeing is probably good for the dollar in the short run.
Yeah, I like that. A little bit of a strong dollar, maybe a headwind for some of the multinationals. Ultimately, that could weigh on the indices a little bit, which in theory might bring a bit of interest back into the treasuries and the futures, which could weigh on rates. So interesting dynamic. And I like how you spell that kind of both sides of the potential outcomes there in terms of the dollar. I wanted to get your thoughts on the Japanese yen, because it's not just rates to the upside that have been fueling some of this bid here in the greenback. I mean, the weakness we've been seeing in the yen certainly is a factor at play, certainly something to consider. You've got the 6J Japanese yen down to levels we haven't seen since March of last year.
Yeah, and you've seen the Bank of Japan in the last couple of weeks doing some more, talking about some more buying of J-REITs a few weeks ago. And then I don't know if it's just if the yen just responding to continued signals from the BOJ that they are going to be aggressive about managing the pace of yields there, or if it's just capital flight out of Japan towards the U.S., where you're seeing strong, exactly the dynamic that we were just talking about, where if you're going to have really strong GDP growth in the U.S. and yields that are now competitive on an FX hedged basis, particularly in yen terms, then you're going to see capital flows from yen to dollar, all else equal. And so maybe we're seeing a little bit of that.
Yeah, it looks like it. We're looking at the daily time frame here. I mentioned the retest here now of those March levels down around that 8,900 level, but I just want to zoom out real quick and take a look. If we do get below that 8,900 level, we're talking again the lows from back in February of 2020, then we'll be talking about levels that we haven't seen here, Luke. Again, going back to December, it looks like the end of 2018, something to watch there. Luke, how dialed in are you in terms of what's playing out here as far as Bitcoin? We just recently got back up into that 60,000 level, but not so much the intraday kind of tick for tick type focus here, but more kind of this underlying trend that we've been seeing to the upside, and the argument or the discussion related to how it's, well, ultimately kind of replacing gold as that a safe haven type tendency, or at least that asset that a younger generation's looking to hold, rather than that older kind of more go-to type GC contract.
Yeah, we've been watching Bitcoin quite a bit, and to me, I think Bitcoin is. I think there's an element where it is taking some demand from gold on the margin. With that said, I think the bigger driver is Bitcoin is really just the last functioning smoke detector. It's the last true market out there, and central banks aren't involved with it.
Yeah.
There is not a big unallocated Bitcoin market that is centralized in London like there is with gold, where they can just create credit gold out of thin air on demand. And it's decentralized, where if you have one of these famous gold smashes where you wake up and come in and somebody around the world decided it was a really good idea to sell $3 billion in gold in 30 seconds at 2 a.m. New York time, knocking the price down 20 or 30 bucks. The futures market is not well established enough for Bitcoin, number one. But number two, unlike gold, where a trader would have to, if they say, well, I want to own the physical and I'm going to take physical at that cheaper price, it's particularly for institutions, it can make a really big difference. It's very onerous to take physical delivery from the centralized exchanges, primarily in London and New York. In contrast, if someone came in and smashed Bitcoin down a bunch, they're not going to be battling with a few institutions in a centralized pool of gold. They're going to be battling with 3 million people with smartphones who are they're going to wake up and go tick, tick, hit. Yeah. And they're going to be able to buy the physical Bitcoin out from under them. And so I think really those market dynamics, I think what we're seeing with Bitcoin, and to a large extent from a macro perspective, is it's telling us the truth about what's happening with fiat currencies broadly. It's telling us the truth about what true real rates are, that they're significantly negative regardless of what the CPI allegedly says. And I think it's telling us the truth about what true underlying volatility in these markets are to a certain degree. And some of the volatility in Bitcoin, I think, is by virtue of it being a newer asset, et cetera. But I do think some of that elevated volatility is actually what's going on in the world. It's just, like I said, one of the few, maybe the last standing smoke alarm that has not been tampered with by policymakers.